Well, welcome back. Markets have turned higher. Take a look. We are about an hour away from the opening bell for a Wednesday. The Dow Industrial is now up 35, and the Nasdaq is up 5.5. The Federal Reserve's rate decision is happening today at 2 p.m. Eastern. Of course, this is the final big event of the year for the markets. The yields, however, are higher right now, even though everybody's expecting a cut in rates. The yield on the 10-year now sitting at 4.20%. Concerns that interest rate cutting cycles could be coming to an end, and that we will have a hawkish tone from Jay Powell when he speaks at 2:30. The central bank widely expected to deliver a third straight quarter-point rate cut. Fed Chair Jay Powell will speak at 2:30, and investors are also watching for whatever he says and any clues on the Fed's future path, including the updated so-called dot plot economic projections or a shift in balance sheet policy. Meanwhile, Kevin Hassett, the front runner for the next Fed chairman, says there's plenty of room to cut rates by more than 25 basis points. Joining me now is MacroMavens President Stephanie Pomboy. Stephanie, good to see you. Welcome back. What are you expecting from the Fed, and do you expect that we'll get a hawkish tone from the chairman, as the yields on the 10-year certainly suggest?
Well, good morning. Yeah, I do expect a 25 basis point rate cut today, and I guess the markets are pricing in an additional 50 basis points of cuts over the course of next year, which is not a whole lot. That's obviously come down. And I think the real issue for the markets is, do these rate cuts succeed in pulling the long end downward? And so far they haven't. In fact, the last 5 times the Federal Reserve has cut rates, the long end hasn't come down. It's actually edged higher. You know, we had 3 rate cuts under Biden, including an outsized 50 basis point cut, and the 10-year yield kept climbing higher. And then the last 2 that the Fed's done under the Trump administration have essentially yielded no benefit in terms of interest rate relief. So I'm kind of wondering, you know, this is a question for Dr. Pavlov, how many times we have to ring that bell before investors realize that Fed rate cuts aren't going to deliver the outcome they have long come to anticipate. So I guess, you know, my maybe cynical analysis of this Fed meeting today is it's largely irrelevant. You know, if the Fed only cuts twice more again after this cut next year, or if they cut a lot, I'm not convinced that it's going to have any impact on bringing long yields lower because of the situation that we've talked about prior, which is this issue of the enormous debt and deficits that, you know, just unfortunately are very hard to contend with at this point. And obviously, if the Supreme Court rules against the Trump tariffs, that's going to just compound the problem of this fiscal dominance issue holding Treasury yields higher.
Yeah, it's funny to see the bond market actually wanting the tariffs to stay in place. And we're waiting on the Supreme Court decision. Of course, this is the last day for arguments at the Supreme Court for 2025. So that means this decision is imminent. And you make such a great point. You know, I had forgotten that Jay Powell actually cut rates by 50 basis points under Joe Biden at one point. You know, we were talking about how political he was to cut rates right before a presidential election and to talk all about these DEI policies within the Fed, but you also have to remember that actually he did an outsized cut as well under Joe Biden, and that was 50 basis points. We're waiting on the employment cost index out any second. It is coming in better than expected. The employment cost index is up 0.8%. That is compared to the expectation, which was up 0.9%. Stephanie, we've had 3 straight quarters of up 0.9% on the employment cost index, and right now this quarterly number is up 0.8%. Your reaction to the employment cost index? How important is this data point for you?
Well, it's very important as relates to this whole topic of affordability. You know, it's going to be very hard to bring the absolute price level lower absent an outright recession that creates this kind of disinflation, and we don't want that to happen, obviously. So the administration's working hard to slow the rate of inflation, but the way they can really win the affordability argument is to get real wage growth up, just get wages growing faster than inflation. So this is a good, encouraging sign. You know, if we can continue to produce solid wage growth, then that affordability question can start to dissipate, you know, and people will get some relief. And obviously, we'll see more of that once the big, beautiful bill kicks in at the beginning of next year. The issue, and I hate to be a broken record on it, is whether the relief provided on the real income front is sufficient to offset the tax of higher interest expense across the entire economy, not just for the federal government, but also consumers and corporations who are struggling to service debt at stubbornly high interest rates despite Fed rate cuts. And just, if I may, to go back to that point about how political the cuts were under Biden, you know, it was even the reason the 10-year yield rose as they cut rates even in outsized fashion was that inflation was still way above the target. And in fact, right now, the Fed, as it prepares to meet or announce its action today, inflation expectations have come down pretty meaningfully, not just in the tips, you know, in the credit markets, but also in the latest New York Fed Consumer Expectations Survey, inflation expectations have started to tail lower, which is a very positive sign and obviously stands in stark contrast to the backdrop when the Fed cut rates under Biden for no apparent reason other than politically.
Well, look, President Trump is trying to message out that story and has done so last night in Pennsylvania and will continue this in the new year. Kevin Kelly, jump in here.
Yeah, Stephanie, I wanted to get your take on the labor market because we've seen actually the ADP reports, 3 out of the last 4 have been negative. So I wanted to get your take on the Fed cutting rates, and do you think they're going to need to continue to do that into 2026 on what you're seeing in the labor market?
Well, I agree. I mean, the backdrop today, again, is, you know, reinforces a Fed cut much more so than the cuts that we saw under the prior administration. There's actually an argument to be made from the standpoint of the weakening in the labor market and the tailing down of inflation expectations and the actual inflation rate. But, you know, again, I come back to this idea. I'm not 100% convinced that it's going to provide the relief that it has in years prior, just because we're now in this kind of new, I hate to use the phrase, a new paradigm, given the fiscal situation that's going to make it very, very difficult to coax long rates lower. And, you know, we really want to see relief, obviously, to consumers in the form of lower mortgage rates. And I don't know if credit card rates will ever come down, but, you know, just generally lower borrowing costs. And as yet, that hasn't materialized. But, you know, again, that's why the emphasis has to come back to creating real solid job growth and strong wage growth. And obviously, the administration's doing everything they can on that score. And so we'll see when the big, beautiful bill kicks in next year to what degree all of that good stuff is able to offset this really new secular issue that we're having with these stubbornly high interest rates because of the debt and deficits that were built up over the last several years.
Yeah, but the big, beautiful bill should be a tailwind for the markets. Look, we're talking about double-digit gains for all the major averages in 2025. Do you think the rally continues in 26?
Well, as I keep saying to you, Maria, you know, I'm not going to fight this market. I think that you're still better to hold hard assets versus paper assets in this environment. And so, you know, I will acknowledge the market's done very well, but it's up 13 and gold's up 55. And, you know, you look at the gold miners, they're up 115%. And even the AI stocks, NVIDIA, is up 33. So there's something going on here where there's a preference for hard assets over paper. I expect that to continue because I think we're going to have to get to a point where the Fed realizes rate cuts aren't working and they're going to have to enlist their balance sheet, at which point it'll be clear that, you know, this is going to be a highly stimulative monetary policy to move forward, and that's going to really favor hard assets over paper. But I wouldn't sell stocks just because it's an inflation hedge. I just prefer hard assets over paper.
Stephanie, great to see you. Thank you so much. Stephanie Pomboy this morning in West Palm Beach. We'll be right back. Stay with us.